Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 14th of March. I'm Daniel Lam, your host for the podcast. The hottest topic of discussion in the financial markets over the last 72 hours must have been the issues and repercussions from the saga surrounding the Californian financial institution. We mentioned this in the podcast yesterday, and let us dig deeper today. Essentially, this was an asset liability management issue caused by the rapid pace of rate increase. Now, this bank, compared to many other major US banks, had a high level of loans plus securities as a percentage of deposits, and very low reliance on the stickier retail deposits as a share of total deposits. Thus, the bank set itself up for large potential capital shortfalls in case of rising interest rates, deposit outflows, and forced asset sales. Now, the good news is that most of the major US banks have more than 30% of their total deposits in retail deposits, compared to less than 10% in this Californian bank. And also, as a backstop, the Fed announced on Sunday that it would make available additional funding through the creation of a new Bank Term Funding Program, BTFP, offering loans of up to 1 year in length to financial institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities, and other qualifying assets as collateral. The BTFP will be an additional source of liquidity against high-quality securities, eliminating an institute's need to quickly sell those securities in times of stress. However, unfortunately, we're not out of the woods yet. This situation complicates the already difficult dynamics with Fed action and the fight against inflation. After Powell's hawkish testimony to the House and to the Senate, the markets were priced for a terminal FFTR of roughly 5.75% by September this year. By the end of the week, this was reduced to nearly 5%. So the situation presents the FOMC with a very tough set of choices. Even if the failure of one bank does not imply systematic risk for the banking sector, can the FOMC risk exacerbating financial stability concerns by continuing to hike rates? But the FOMC rate hiking cycle has yet to conquer inflation. So even if the US economy has already embarked on a downward move, the FOMC is hardly in a position to cut rates with inflation still so far above target. So this may prompt US consumers and businesses to retreat from spending and investing. And the increased risk aversion would likely outweigh the perceived benefits of the FOMC pausing or completing its rate hike cycle. So again, this adds to the imperativeness of our safe approach to rotate into high-quality bonds and to extend average maturities in one's portfolio. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.